Hi, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for July 12th of 2025. First chart we have here is National Federation of Independent Business, their Business Uncertainty Index. What we've seen here lately coming out of Washington has been a lot of rhetoric with regard to tariffs, and that's naturally leading to heightened uncertainty. And you can clearly see that here in this chart that we have that spike in uncertainty with the tariff tantrum. It has come down, but it's still at fairly elevated levels. Here we have the data looking at it on a monthly basis. You can see that there's really been only 1 month this year in 2025 where we have had positive optimism, or at least optimism change on the part of small businesses. The rest of the time, with the uncertainty related to tariffs, that we've seen these negative numbers. Now we'll spend a little bit of time with economic growth. We have the numbers from the first quarter here. As well as the estimate for the second quarter, which ended on June 30th. We'll get those numbers here in about 10 to 14 days, roughly. And currently the estimate is for 2.6% positive annualized growth. That comes on the heels of a negative growth rate for the first quarter. Here you can see the legend for the, really the derivation of these various components to GDP. You can see here that we have very positive influence from inventories that were accumulated ahead of the tariffs. And correspondingly, we also had a rash of imports ahead of those tariffs, as you might imagine, trying to get out ahead of the announcement, which came in very early April. And so anytime you have a situation where you have a rash of inputs or imports that exceed your exports, you're going to have a negative effect on GDP from net trade, and that's exactly what happened in the first quarter, and it's largely the reason why we were negative in economic growth annualized in the first quarter. Now, essentially, all of these components are expected to kind of reverse for the most part. The lone exception here, and this is very important too, is the consumer spending number has been very strong, I'd say almost more consistent than it's been strong. But you can see here in the green that it was a positive influence in the first and likely to be a positive influence in the second quarter here. But we're getting a reversal in some of the trade figures, and as well as we're getting some reversal in inventory accumulation, which, by the way, going from one quarter to the next, it's not uncommon to see these types of like reversals, really to get a sense of what's the health of net trade and the health of inventory accumulation. You have to look at it on a 2 or 3 rolling quarter basis to get a real sense of it. In this slide, we talk a little bit about the dollar. We got a couple of slides on the dollar in the chart pack this week. Dollar's been very weak this year, and to put it in a kind of its own little microcosm, I mean that's what we're talking about right here. If you go back to 2005, you can see that the line of best fit here. I mean the trend line is clearly up, and we had a very strong end of last year, and this is like just basically reversing that. So let's not get carried away with the dollar itself, but it is important to recognize that we have had a pronounced level of weakness that is giving back a lot of what we gained here going back to the pandemic. Now, one of the things that has come up is, the dollar weakness and, Trump's tariffs and, this kind of like unwinding of the U.S. exceptionalism theory, is going to lead to, a large disintermediation out of the U.S. dollar, and people are going to stop using it as a reserve currency or as a basis of trade. And this is a chart that kind of talks about that. So if you go back to the beginning of the century, the dollar accounted for, essentially about 70% of transactions. And that number now is maybe 60. You can see, what's going to displace it? I mean, you have these basket of other currencies, which has expanded, but really you haven't seen a lot of gain either from the euros, the yen, or sterling. This is, maybe the Chinese yuan kind of crowding in here a little bit since its accession to World Trade Organization. maybe so, but again, the US dollar is not going anywhere anytime soon. Here we have more information on the dollar. This is interesting in itself because there's usually a tight correlation between these two. And again, if you go back to really about 2 years ago, you can see the volatility in the US 10-year Treasury rates, and that's in this darker line here. Green line represents a dollar spot index, and as you might imagine, if you're if your dollar is strong, that tends to correlate with a high interest rate. And conversely, if your interest rates are high, people want to engage in your currency, and there's a demand for your currency, and that tends to drive up the dollar. And that relationship has worked really well until the tariff tantrum in April, and then we've had a disconnect. And there's really one of probably three ways to adjust or to correct for this. One, you could have your yields basically move lower to catch up with this. You could have your dollar rise to meet where your interest rates are, or you can have something that kind of meets really in the middle, and that's, I think, where we're going to be. So in talking about depreciation of the dollar, this is assuming that you have like essentially a two two-pronged depreciation. You get like cumulatively a 20% degradation or depreciation in the dollar, and that doesn't happen necessarily all at once, but what is the impact of a dollar decline on inflation? And been a lot of discussion about that. And so here we've got this analysis. If you look into the fourth quarter, into roughly the third quarter of 2026, that the impact at its greatest point will be basically about a half a percentage point from its baseline forecast without that depreciation in the dollar. So recession, has been in the discussion for some time. It basically, went down quite a bit. Now it's percolated up to, some levels of conversation in the wake of the tariffs and the fact that there's a lot of uncertainty, and these tariff announcements seem so indiscriminate and really non-correlated to any type of financial backdrop or formula. Has led to a lot more conversation about, are we going to have a recession? What's the likelihood of it? There was a point where in April that probability was inching up closer to 50%. That has dropped now, and I think if you look at Goldman Sachs, J.P. Morgan, some of the other folks out there, then that number is kind of somewhere between 20 and 30%, which is not insignificant. Again, I don't think personally that we're going to have a recession, but again, the fiscal policy is very unpredictable right now. And where even if you look at this number, which comes off the Wall Street Journal's consensus, or you look at some of the larger investment banks, and even in this range, it is higher than what we enjoyed, over the last decade or so. And this, you can see here, it usually, at most, it will generally get to, if you're in recession, then you're going to hit 100%, which was the case here. But you're never usually going to punch higher than about 60, 70% without having a recession. But if you're down like, 10 to 20%, that's very, very low. On this slide, we have really some expectations for future inflation. You've got in this black line kind of the actual to date numbers. And then here we have various timestamps of what inflation looked like. If you go back to January of this year, before all of this tariff announcement stuff, fairly benign, looking for continued long-term decline in inflation here. Then came the April tariff announcements, and then here we are in July. And so this chart really almost also speaks to kind of the nature of the inflation that you might get from tariffs. And if you think about it, you get like a one-time hit to to inflation from a reset in prices. Like if you implement a 100% tariff, you're going to have a one-time reset in prices, which is going to prompt people after a relatively short period of time to look for substitutes. And if they don't find substitutes, they're going to transition and just simply consume less. And so really, in the short term, you have an inflation event which may play out over, a matter of months, but then that translates into more of a growth story, which is, I think, what's being reflected here, that we get back to this trend line where we're at right now over time. So we think about inflation, there's kind of the near-term element of it, and then there's a long-term element. And, near-term expectations with tariff, as we saw in the last chart, you have that bump, but then it goes back down over time. And this chart it really emphasizes that point. And in the blue line, we have the 1 year ahead inflation expectations. And those are, as we saw in the last chart, elevated. And then they do come down, and this is where we are right now in July. So, after the tariff announcements, maybe we were expecting a little bit more inflation over the next year, and that's kind of slid down a little bit. Maybe that goes up again. I don't know. But the long-term or the 5-year inflation expectations are very well anchored and have not moved very much at all. Here we have deportations, kind of maybe a little odd slide here, but it does have ramifications to the labor supply, as we talked about in several industries, ranging from agriculture to many of the service industries. And you can see that, basically detainees released for removal, this is the policy that's now in play, right? I mean, it is the policy of the Trump administration to manage immigration. But it's also important to recognize that if you remove those workers out of the labor supply, where they've been consistent contributors for a long time, that has disruptive elements to it. And I just don't think this data is so fresh here that I don't think it's manifested itself in the actual fundamentals yet. Talking about the labor market, here is a depiction of initial jobless claims. So, as we kind of look at the labor market in general, it remains relatively strong. Really, we've had some modest upticks in the unemployment rate. We've got jobless claims here that are moving higher. They're not yet above prior peaks. 240,000 is not an insanely high number, and not necessarily something that would get us all worked up just yet, but it's something that we obviously want to monitor because, this is a pretty representative trajectory. And, again, we've seen these types of moves before that have, had their tops and kind of reversed. Obviously, this is still moving higher, so we'll just have to monitor. We have a chart here that kind of speaks to the willingness or the resistance on the part of companies to pass through tariff cost increases. And really, it's a pretty interesting case study because, on the one hand, you've got, basically a quarter of the companies that say we're not going to pass through any of it. So, these are the companies that are probably a little bit more challenged with regard to market position, and they want to maintain their share, so they're willing to take that margin hit to operating profits. And then you've got varying degrees of firms that will say, yes, we'll pass through some, but not all. And then, here you've got, a lot of companies that are willing to pass through all of it. And, the blue line or blue bars here represent manufacturers that are willing to pass. Basically, almost a third of the manufacturers are saying we're going to pass through the whole thing. And then you've got almost half of the service firms that say that they're going to pass through the whole thing. And we've got some data from the International Monetary Fund on what they believe is going to be the impact to economic growth from tariffs. And this is like basically looking at it from the standpoint of what's the impact to their pre-tariff forecasts due to the implementation of these tariffs. And Again, most countries are going to witness some type of an impact, and oddly enough, the instigator is going to take it in the shorts more than most of the rest of the world is by the IMF's estimation. Interestingly enough, we've got Spain here, which is looking to expand its economic growth, which probably is just a stronger overall economic revision, kind of net of the tariff impact. Like Spain, just in the IMF's views, their growth rate has accelerated recently. So that's probably why they're an outlier. But everyone else generally is going to have some hit from tariffs. And then just again to reiterate that we're the one who's causing all this commotion, and we're likely to take the biggest hit. Federal debt is something that I've talked a lot about, and in light of the One Big Beautiful Bill Act, the OBBBA, it's not fiscally responsible on its face because it does emphasize and reinforce deficits. And as a result, here you've got basically the Congressional Budget Office (CBO) expecting federal debt held by the public as a percent of GDP to continue to climb well north of 150% of GDP. Looking out over a period of like say 30 years. This is not, in my view, a sustainable track, and there will be a reckoning. And the implications of having, a fairly consistent rise in public debt is that it lowers your overall long-term potential growth rate. And you can see here, going back to World War II, I mean, we had a very dramatic spike in debt as a percent of GDP. But as soon as the war was prosecuted and won, then that came down. And we've had instances where we've had increases in this number, but they've generally been followed by reversals. And here we've got the war on terror, and then we really, with the exception of the pandemic, like the immediate aftermath of the pandemic, I mean, we've seen these like dramatic increases. And again, this is something that over the long term could impact the strength of the dollar as a reserve currency. It could impact, as I mentioned, our growth rate, and obviously it's going to impact greatly over time the fiscal burden of having to pay the interest on all that debt. Here we have essentially a disconnect that's brewing between U.S. equity markets and interest rate expectations on the part of the Fed. So here we have interest rates that are looking to come down, but at the same time we've got equity markets that are moving higher, and the proxies for these things, at least for equities, is essentially the Goldman Sachs U.S. cyclical index relative to the defensives if you back out commodities. And so it's not an index per se, but it is an index that is really indicative of what's going on in the marketplace. And then the interest rate basket, or the interest rate expectations, are defined by forward swap rates 1 year out. And so you can see the tight correlation that exists. Again, back in July of 2024, we saw a similar disconnect, but generally speaking, we have a pretty good correlation here. This is widened out, and again, I say there's one of several things that can happen. These two may find a spot in the middle to meet, which is probably most likely. So something else that's worth mentioning here is something we've touched on in previous charts of the week after the tariff announcement is, what's the appetite going to be for U.S. risk assets and U.S. risk-free assets? And the thought at the time was just speculative, and we didn't really know what was going to transpire, and we still really don't. There's still a lot of demand for U.S. assets, and this is a chart that kind of shows you the degree to which these instruments are foreign owned. And you look at the U.S. equity market, I mean, we have $18.5 trillion that's owned by foreigners, and that represents 20% of the total equity market. And it's even more when we talk about the fixed income side of things, where we've got $8.5 trillion, or 30% of the total treasury market owned by people outside of our borders. And same percentage goes for U.S. corporate credit, although the aggregate amount is a little bit lower here, about 4.6 trillion. So again, it's worth thinking about what are the implications of continued aggressive trade tactics. And again, when you think about like a weaker dollar, if it's expected to continue to weaken, then that could temper like the translated returns of, maybe higher interest rates in the U.S. That gets offset by a weaker dollar, and so that may temper the enthusiasm. But as of right now, there's still a tremendous amount of enthusiasm and demand for U.S. assets. We talk a lot about the health of the consumer, and we showed you a few slides ago in the breakdown of the GDP economic growth components that consumer spending has been very stable and expected to remain so for the foreseeable future. And one of the ways that we can kind of track that, again, this is just one proxy of the overall consumer spending picture, is by looking at retail sales. And here we have monthly change in retail sales mapped against consumer confidence up here in the blue. And we do know that the consumer confidence number is a soft data point. It's a survey. You're asking somebody how they feel, not a measure of what they actually do. This is the hard data. And by and large, the hard data has been very positive. Soft data, not so much. Here's one reason why we kind of talk about these two things as mutually exclusive. And we take basically soft data is helpful in terms of like budgeting for potential risk on the horizon, but it's not something that you hang your hat on all the time, because you can see here there were some strong positive data points on retail sales at a point where you had declining consumer confidence. So again, I do think that this, to the degree that it has some pretty strong downdrafts, it may lead actual hard data by some months, but that's really hard to tell by looking at these two data points overlapped on each other. Now, the other thing that we're watching here is delinquencies, and we've talked about this. We've seen those tick up a little bit. I wouldn't say that they're areas that we need to sound the alarm, but we need to pay attention to this. And whether we look at auto, we look at charge card, or even mortgage delinquencies, all of these things are moving a little bit higher. One thing I've been paying attention to has been the overall deal market, and and this could be a sign of several different things. But we'll look at the data itself, and you can see here, that we've had, really over the last year, we've had kind of a general uptick in deal value. Here's the deal counts have actually dropped here lately, but basically been offset by very large deals. And so the deal count estimates for this year may be a little bit off of, like looking at it from a quarterly basis, maybe off of the last couple quarters, but still very strong. So you think about deals, you think about, okay, why are people doing deals? Are they not finding growth opportunities? So they're doing acquisitions to acquire that growth, or in some cases, companies that may feel like, okay, I want to get out ahead of this weakness, and so they become targets themselves. And so there are a lot of reasons why this can happen, but in many respects, this is positive to see that the deal markets are actually fairly fluid right now. Here we have a breakdown of essentially company guidance, and this is actually broken down here, looking at the S&P 500 as a whole, but then breaking it down by the various GICs, or the various industry sectors. And what you find here is, in the aggregate, about 60% of companies are reducing their guidance, and about, oddly enough, not quite 40, call it 35%, are actually raising guidance. And you can see how that kind of moves through different sectors. Like utilities, you have a vast preponderance of companies that are actually raising guidance, and more so energy, real estate, so on and so forth. So it's not uniform. And again, we've had net declines in in forward estimates, which I think is very healthy, natural, and I think it's good that we have the estimates coming down. But as you can see here, this is not an entirely bleak picture by any stretch. I mean, there's still a lot of companies here that are actually doing well and are expected to grow faster than had been previously expected. So we also want to look at the earnings outlook across the global spectrum. We know how well a lot of these international markets have done, certainly relative to the U.S. here in 2025. And so, we go back to basically the end of last year. U.S. expected to grow earnings by 14.3%. That number now looks like 9.4. So, as had been alluded to in the prior slide, estimates have come down. And again, I think it's a good thing. Whereas, oddly enough, in Europe, estimates are moving higher. And Japan, they're moving down a little bit, and then emerging markets moving higher. And as we see here, I mean, we get some of these impacts that may not be intuitive on its face, but we're getting a huge tailwind in, I'd say, by and large, in all of these markets from currency. With the dollar being weak, this is actually helping like these translated earnings quite a bit. And so maybe you have core earnings growth, which is declining in Europe and maybe sluggish in Japan. The fact that you have such a weak dollar makes that a moot point. So, it'd be interesting to watch how this plays out. Again, takeaways here. Glad that U.S. growth rates are moderating a little bit, and really to understand why some of these growth rates are expanding in perhaps some of these other regions. Quick comment on rents here. It is important to the inflation picture, as we know that the various components of real estate account for a very large, an appreciable part of the core consumer price index. And so, we look here, we see asking rents have been relatively flat, and I'd say that the overall rate of growth as depicted here is actually still in somewhat decline, but the thing here is that they're still elevated, right? If we go back to before the pandemic, and where they are now, these are still at elevated levels, even though we've gotten some relief. And so when we talk about like the annualizing inflation data, like owners equivalent rent and rents were really high and it caused that CPI to remain higher than it would have been. But with getting out a few years on the horizon here with relatively flat rents, even though they're higher, it takes away that impulse into CPI and allows CPI to be perhaps influenced a little bit more by other factors. Now we'll get into some other sentiment data and other economic data. Here's the American Association of Individual Investors. This is their bull bear sentiment indicator. Right now it's looking a little bit bullish. It had been somewhat bearish after the tariff tantrum. Still a little positive. You can see that this does have the propensity to kind of jockey around a little bit, even if you're in kind of a trending up market. Here we have consumer credit, and you can see here that consumer credit, is trailing off. This is the zero line, so you can see that we've actually had a net contraction in revolving credit outstanding. So this is maybe a byproduct of consumers trying to be a little bit more fiscally responsible within their own households. Here we have consumer credit total net change, and this is a seasonal adjusted number, about 5%. This is total consumer credit. Here we have the rate being charged on credit card accounts, and you can see that this is still extraordinarily high, even though it's come off its peak. I mean, we're still talking about over 21%, which, if you go back, to the high interest rate days, kind of like after Paul Volcker took the chairmanship of the Fed and started really raising rates to curb inflation, these numbers were not even close to where they are now. So this is a highly unusual environment. Here we have rates on new cars, and again, we had higher rates dating back to prior to the global financial crisis, and we're kind of at these levels now. Again, just like with credit card debt, I mean, we're off the peaks, but we're still at a fairly high rate that is well above where we were prior to the pandemic. Here we have the mortgage rates from the Mortgage Bankers Association. You can see the downtrend over multiple decades here. And then, we're still kind of stuck in the 6.5 to 7 range. And you can see that even though these rates have been flat, affordability still remains somewhat challenged because we have high prices. And the fact that these rates are higher in the aggregate than anything that we've been used to, really going back to almost the beginning of this new century here. And you can see that the rate of change has also elevated quite a bit here recently as well. Here we have the purchase index for the Mortgage Bankers Association. Still somewhat weak. I would still categorize it. Any of this data here, even though it looks like it's coming off its trough, is still pretty weak. And so housing itself is still a bit challenged. I'd say it's kind of on balance a net drag on economic growth, but it is somewhat positive to see a little bit of an inflection point here. Here we have something I found very interesting. So you have wholesale inventories and wholesalers sales, and these are mapped against each other. The sales are in the blue and the inventories are in the amber line. And you can see here that this data is very noisy, but it was interesting that this is the first time in a while that we've seen both of these be down at the same time. That's not to say that it hadn't happened before. Here there's some notable moments where that has played out. But after this kind of like aimless trend here, looking back over the last year, to have these both trend down could be symptomatic of the effects of those tariffs, like the 10% baseline tariffs that are kicking in. This could be symptomatic of those effects now finally filtering in through the system. Last two charts here kind of reflect things that I feel are pretty interesting out there right now, and this is kind of a generational tracking of ownership of U.S. equities and mutual fund shares. And so, when you think about this, the silent generation, baby boomers, these two own more than 70% of all equities and mutual fund shares. And but you can see here, like if you track it from 2020 to 25, so again, 5 years does make a difference. And you can see that these numbers are slowly going down and giving way to the millennials, even Gen Xers, right? That's another generation which really has not, we haven't seen the bulk of this wealth transfer from the baby boomers yet, because these people are over the age of 65. And again, that's where all the wealth is happening. So eventually you'll see this transition giving way to the Gen Xers, but you've seen a pretty dramatic rise in millennials too. So that rising generation, they're becoming shareholders, and they are activists, and they're getting involved, and it'll be interesting to watch. Last slide here is something that's a little bit near and dear to my heart because we have a college planning practice. This is a chart that shows you the price change expectations for the cost of college education. You can see here, the current estimate looking out 1 year is for about 9%, which you think about it, is about 3 times the rate of inflation. And you can see that has moved up quite a bit, and but it has been high before. And we all know that cost of education volleys around a bit, but 9% is pretty high. And for parents that are preparing to send their kids off to college, this is definitely a consideration on family finances. I hope you've enjoyed the chart pack. I hope you have a wonderful week. I will be on vacation each of the next 2 weekends, And so the next time you'll get a charts and chat from me will be about 3 weeks from today. So in the meantime, have a terrific several weeks.